afternoon to you all. My name is Maruni Salalani, and I would like to welcome you this afternoon to this webinar on financial protection. I'm actually joined in this webinar by Richard Collins, who's our Head of Standards. And I would also like to thank you for taking the time out of your busy schedules to be with us this afternoon. The webinar is due to last for about an hour, and we will first begin with a presentation for about 20 minutes, which will be delivered by Richard Collins. You do not need to take any notes, as the slides have been uploaded. At the end of the seminar, you are going to have an opportunity to ask us any questions, and we would welcome them, and we would also welcome your initial thoughts and views. The webinar attracts CPD points, and we will give you the CPD authorization code at the end of the webinar. Like some of you, we are also new to a series of webinars, and we would really welcome your feedback on whether this is a good approach in engaging with the profession. You will be able to find recordings of this and other webinars covering different subjects on our website at www.sra.org.uk/webinars. I would encourage you to inform your colleagues about this. We are also planning further sessions, so please keep an eye on the website. Our aim is to help those who we regulate understand and prepare for the fundamental changes to our regulatory approach, which is taking place over the next few months. We think our initial feedback tells us that the webinar seems to be a good way of providing us with an opportunity to engage with the profession. Before I hand over to Richard to deliver the presentation, I would like to say a little about myself. I have been with the SRA for about 5 years, and am currently the Director of Inclusion. Amongst my responsibility includes advising the SRA on matters of equality and diversity, and ensuring that the SRA's regulatory policies, practices are fair and proportionate, and that the SRA takes due regard of equality when taking decisions. Richard and I are working very closely together to ensure that the financial protection review and the proposals that we have before you have considered equality impact across all the spectrum of strengths that are now covered by the Equality Act. I would now like to set the context for this webinar. Why do we need the review of client financial protection? We have been aware for some time that there have been difficulties in the professional indemnity insurance market. We have also been aware that this has been due to some of the economic downturn we've seen recently, and that this has impacted differently on various parts of the profession. We have seen an increase in the value of claims, and we have seen a significant increase on firms entering into the ARP, which means that this has resulted in a high cost of ARP claims and an increased cost to indemnity insurance and the compensation fund. We are also aware that profession, and particularly small firms, have found it difficult to get insurance cover, and where they have found cover, this has been costly. With this in mind, and the changes in the legal landscape, such as the incoming alternative business structures and the move to outcome-focused regulation, it would not have been possible to retain the current system. Therefore, the SRA board decided it was time to carry out a root and branch review of the whole system of financial protection for clients, which has resulted in a number of proposals. We are consulting on these proposals, and we will summarize them for you in the presentation Richard will deliver. Before I hand over to Richard, I would like to assure you that the consultation is open, and we are interested to hear your views. This is a difficult and complex area with a range of competing stakeholder interests, and therefore it's important that we have a wide range of views from all our stakeholders, including yourselves, to help inform our final policy and decision-making in what is a very difficult area for all of us. I will be staying on for the duration of this webinar presentation, and would like to hear your views and any immediate questions that you may have after listening to the presentation. We have also published our initial equality findings on the key proposals, and Richard will summarize these for you as well. Thank you. I will hand over to Richard.
Thank you, Marinisa. Good afternoon, everyone. I'm Richard Collins. I'm the Head of Standards at the SRA, and I've got responsibility for overseeing this review of financial protection. As Marinisa said, this is a fundamental review of the whole system, which we kicked off in the summer of last year by appointing Charles River Associates to undertake, as Marinisa said, a root and branch review of the current financial protection arrangements. And we felt that was important because of what we were seeing happening in the market at the moment. It was clear to us that our reaction to that shouldn't just be one of trying to make simple adjustments, but we felt it was necessary that we had a thoroughgoing look at the whole system. Charles River undertook that independent review. They are economic consultants, so they very much approach this from the principles of better regulation, to look at the system and ask the fundamental questions about why is the SRA regulating in this area, where are the market failures that suggest that the SRA needs to regulate, rather than leave professional indemnity insurance particularly to the simple operation of the market. Charles River produced their report. They undertook a lot of engagement with stakeholders, with solicitors firms, representative bodies, the insurers, and some of the major purchasers of legal services, such as the Council of Mortgage Lenders. And we ourselves at the SRA engaged in a significant amount of engagement with stakeholders during that period through the establishment partially of an external stakeholder reference group. We then published the Charles River Associates report because we felt it was important that people could see the analysis that Charles River had gone through. We ourselves at the SRA then considered the report, and in December we published our own consultation paper. And it's the proposals in that consultation paper that I'm going to talk you through today. I think it's important at this stage, though, to say the Charles River work was important in informing our thinking, but we haven't simply adopted their recommendations, and our proposals differ from their views in some respects. The consultation runs through till the 28th of February, and then we have a short time to reach our decisions, to make any necessary rule amendments, in order, we hope, for the first raft of changes to come in October of this year. This slide summarises the 4 key proposals that we're making for operation from October 2011. What we've done in the consultation paper is split it into 2 parts. We're making quite specific proposals for October 2011, but the second part of the paper goes on to seek people's views on other changes which we might consider making from 2012 onwards. And I'll come on to those in a minute. So the 4 key changes for 2011 that we're proposing: firstly, that we will remove the restrictions which mean that there is a single renewal date at which the whole profession has to renew its PII. Secondly, we are proposing that we permit the removal of cover for work undertaken for financial institutions from the minimum terms and conditions. Thirdly, that we implement some further controls over the assigned risks pool. And fourthly, that we carry out some clarification on the obligations for insurers to provide information to the SRA. And I'll talk a bit more about each of those in turn. So, Proposal 1, this is that from the 1st of October, we get rid of the single renewal date. Charles River's analysis of this was that they could see no market failure for which the answer was to have a single renewal date. So basically they could see no good reason for us having it. It was seen very much as an accident of history. And indeed, a bit more than that, they felt that the presence of the single renewal date actually caused some problems for people in the market. This pressure during the month of September for insurers to deal with so many thousands of proposals for new insurance, and the pressure on solicitors Charles Rivers felt that that was causing difficulties, and we agree with that. It's quite clear from the fact that we have quite often several hundred firms making protective applications to go into the ARP in October, who then quite successfully put in place insurance during the course of October, suggests that there are real capacity issues for everybody in trying to get this done in September. So the proposal is that we get rid of the compulsion of a single renewal date, and that will allow firms and insurers to decide when they want to institute new insurance arrangements. Undoubtedly, it will take several years for this huge bulge to unwind, because I suspect that if we implement this come this October, many firms will simply in October take out insurance for another year. But other firms may choose to align their insurance with their own financial years, for example, or they may choose to take out insurance for 18 months or some other period. And we believe this will be an important freedom in the market, and it will deal with some of the problems caused by the current arrangements. The second proposal is that we permit the exclusion of cover for claims by financial institutions from the minimum terms and conditions. This, I can already see, has probably been the proposal that's received the most coverage in the press and in debate. But it's quite important that I explain the context and also our views about how it's likely to operate. At the moment, the minimum terms and conditions mean that insurers can only offer insurance which covers all potential clients of solicitors' firms. And all solicitors' firms, whether or not they undertake work for financial institutions, have to take out cover on that basis. What this new arrangement will mean is that if a firm, for example, does no work for financial institutions, it will be able to say to its insurer, we'd like cover, we'd like the exclusion in, and that is a way of signalling to the insurer that they don't do work for financial institutions. And really the biggest area of work affecting firms doing work in this area is conveyancing work where they are undertaking work for lenders. We think probably about 30% of the firms in this country don't do conveyancing work, so that is probably the upper bound of firms who may seek to take out insurance with this exclusion. For firms who do, for example, do conveyancing work and wish to continue to therefore to have cover for financial institutions, they will seek to take out cover which may well be exactly on the same basis as it is now, exactly on the same scope covered by the minimum terms, with their insurers to permit them to carry on doing work for financial institutions. I would expect the reaction from the financial institutions, from lenders, to be that they will only wish to continue doing work with firms who take out this insurance cover. We think this additional flexibility in the market will be helpful. It will enable firms who don't do this work to signal that quite clearly to insurers, and we believe it will help a number of firms who currently end up in the ARP to obtain insurance, quite possibly with this exclusion in. This is going to be a key issue for us in dealing with the responses to consultation, and we will particularly welcome views from firms about how they believe this will operate and what they feel the impact will be. The third proposal is that we put further controls on the operation of the ARP. Last year we moved the time period for which firms could stay in the ARP down from 2 years to 12 months. We're now proposing to reduce that to 6 months, and also to require firms who go into the ARP to develop plans to exit the ARP. One of the things that I've observed from looking at the operation of the ARP is that I see some firms who move into the ARP aren't really using their time in the ARP to plan for their successful exit. And firms either will have to think about why it was that they couldn't get open market insurance, what were the particular risks that the insurers saw in their firm which made them unwilling to offer insurance, and take steps to address those risks, or if firms feel that they are going to close their firm, they will need to plan for an orderly closure during their time in the ARP.